Hey guys, I'm Rose. Hodge won't be joining us on today's episode. She's doing a test. Ooh. All right, okay. So, welcome back to our channel and a huge welcome if this is your first time joining us. Today is all about financial literacy from saving your money to life insurance. So, we have our special guest, Terrance Brewer, or better known as Financial Coach T. He will be telling us about what he did after high school and the journey that got him to where he is today. So, welcome, Terrance. Thanks for joining me and our listeners. So, you're just going to kind of tell us who you are, what you do, and go from there.
All right. I want to thank you for inviting me and allowing me to be a guest on your show.
Yay.
My name is, again, Terrance Brewer, or better known as the Financial Coach T. After high school, graduated from A. Philip Randolph. After high school, I was actually presented with the opportunity of being an intern at a company called CSX. It's a railroad company, but I was in the IT department. I stayed with CSX for about 9 years until they started doing layoffs, and I got caught up in the layoffs. Before the layoffs, I was the supervisor at their service desk, and I was making pretty good money. I was making about $75,000 a year at the age of 25.
Wow.
Yeah, 25, 26, and I was making pretty good money, but I was still living pretty much paycheck to paycheck, and I'll get to why in a little bit. After that, like actually a couple months before that happened, one of my colleagues in a different department presented me with the opportunity to learn a little bit more about money, and then in turn show other people how to do that and be compensated for it. And because I was making that type of money but still living paycheck to paycheck, I was praying for something to do on the side, because being a supervisor, I was blessed with an awesome team. So I loved my team and I didn't want to go away from that, but I know I needed some extra money. So I took him up on his offer and started, getting mentored, not only from him, but I had the mentor from $1 million earners. So that was awesome. So
Wow.
Fast forward 2 months later, after being presented with the opportunity, CSX let me go when the new CEO came in. That was the first taste of you can't rely on a job. That we always been taught to go to school, get good grades, go to college, get a good job, stay there until you retire. So that right there, that ruined that vision for me. So I knew at that time the system was broke. But I was fortunate and blessed to be presented with an opportunity to work for West Rock. It's a paper and packaging mill in Fernandina. I wasn't looking for a job at the time. They actually found me off of LinkedIn. So, I'm thinking, it's a sign from God. And I was the IT project manager out there, again, making way more than I was making at CSX. And things were a little bit better because I had that financial education that I was, working with a mentor to learn and stuff like that. And so I was able to handle my money a little bit better. I started paying off debt. I paid off my student loans. I had about $30,000-$40,000 of student loans that I was able to pay off in less than a year. I got it down to where all I had left was $6,000 of credit card debt and then my truck. So because of the knowledge that I learned, I was able to pay off a substantial amount of debt within a year and a half, to where all I had left was $6,000 of credit card debt and my truck. And I had probably a total of, I want to say, close to $80,000 worth of debt, period. So I'm down to less than $20,000 of debt left. So, I mean, it's been a blessing.
That's a big difference. That's a huge, huge gap there.
Yeah, it's definitely been a blessing. So working at West Rock, I want to say this first. They were one of the best people to ever work for. I love the environment. I love the people. But at the same time, it kept weighing on me. As I continue to get immersed in the world of business and be around other people that run a business and have the opportunity to do the same thing within the financial industry, I kept on getting this nagging feeling of I don't want nobody else's thumb pressed on me. Although the company was awesome and great, I pretty much worked 24/7. Anytime we went on vacation, I had to work. So my kids, they're out there enjoying. I had to, excuse myself and knock out some work, or I'm always on call and stuff like that. And it was pretty much taken away from my time that I wanted to, be with my girls and stuff of that nature. So I made a decision in September to quit my job and go full steam into the business of helping others.
Mm-hmm.
So I've pretty much been job free since September 2019 and been working in my business since then.
Wow. That is a lot of information to process at one time. So just a few questions. So tell us what made you choose the path of basically retiring at what, you're in your 30s?
I'm 29 right now.
29. What? Retiring at 29? I can't even fathom that. So tell us how we can retire at 29.
All right. So I wouldn't say I'm all the way retired now. I just fired my boss. So one of the things is, like, you don't need a paycheck, you just need an income. And a lot of us forget that, and we forget our dreams because we're selling out to a paycheck. So they got us pretty much blinded by that paycheck that sometimes once we get off work, we stop the hustle. We're hustling so hard for other people, but we don't hustle for ourselves.
Right.
So I because the environment I'm around, I was encouraged, and I have a great support system. So a lot of us aren't going to take that jump if we're not surrounded by an environment that encourages that kind of courage or whatnot, because they say you are the sum of the people that you hang around. So
right.
But retirement again is not an age, it's a number. So a lot of us too many times are thinking, oh, I gotta be 67 till I retire, and by the time we retire, the age probably going to go up to 70 because it keeps going up every couple of years. It was 65, now 67. But retirement is a number, not an age. And to identify that number, you need to know your financial independence number.
Okay. And what is that?
So your financial independence number is the amount of income that you have to acquire so that you'll never have to work again. So say that your financial independence number is 1.3 million. Once you accumulate 1.3 million, you'll never have to work again after that. So a lot of times what you see is a lot of people don't know their financial independence number. So they'll work for a company for 30 plus years and never know what the goal is. And a lot of times they have to go back to work. You see them as a greeter at Walmart or Home Depot, or they go out and get a second career. So most people don't plan to fail, but they fail to plan. And that is another thing that we help people with.
Okay, so do you guys help people with life insurance, or is it mostly about savings, or what do you help people try to just how to focus and find what that financial number is for them?
So good question. So we handle the whole financial profile. We don't just do life insurance. We don't just help you find your financial independence number. One of the best things that we give to people, and it's totally free, it's totally complimentary, is a financial game plan that we call a financial needs analysis. So
Mm-hmm.
so what that is, it's a digital tool, much like a GPS on your phone or in your car, that shows you where you currently are financially, and it shows you how to achieve your financial destination, just like your GPS in the car. So
Mm-hmm.
just think about this. If I asked you to go meet me in Toronto, Canada, you never been there before, you can't use a GPS, you can't fly, you have to drive, and you can't use a map, would you know how to get there?
Not a clue.
And that's just like financial independence. Because we haven't been there before, we don't have the directions or the roadmap laid out in front of us, and that's what a GPS is for. And this financial GPS shows people how to achieve financial independence. And through that game plan, we're able to show you your financial independence number, your net worth, your financial house, how to eliminate your debt quicker
Mm-hmm.
using the same money that you're using now, but because there's a strategy behind it, you're no longer shooting a shotgun at the target, you're using a sniper hitting the bullseye every time, allowing you to eliminate your debt quicker.
Mm.
We show you how to create the three fundamental accounts: your retirement, your short-term savings and emergency account, how to minimize the budget, and we compare the different products that you already have, like life insurance, auto, home, and your mortgage, and different stuff of that nature, and see if we can save you money or bring you more value. And if we could do those things, it'll make more sense to save you that money and bring more value, so that you could use that extra cash elsewhere, whether it's to give you a buffer between living paycheck to paycheck or putting more towards your investment so that you can be financially independent quicker.
And for those who opt to get life insurance through their job, is it better to have life insurance through your job or versus getting one on your own? What's the way to go? What's the path to take when it comes to that?
All right, so if you get life insurance through your job, cool, but get what's free. Do not pay for anything extra. But you always want to get something outside of your job. Always. You want to have something personal. Why? Because God forbid you leave that job, what happens? The benefits stop.
Right.
So, and then once you go to the next job, you get another benefits. But what happens if, God forbid, something happens to you between, you getting that new job? Or what most people don't know is, if you don't read the policy that you get from your company, one, you don't own that policy, the company does. And two, if you're not active, like active full-time employee at the time, God forbid, something happens to you, your benefits, they don't have to pay out. So say for your company, you have to do more than 36 hours to be considered full-time.
Right.
And you've been sick or whatever, and you've been doing 20 hours or whatnot, they don't have to pay out that death benefit, God forbid something happens to you. Wow.
I never thought of it like that.
Yeah, and a lot of people don't know that. And then think about this. Companies are giving less and less benefits. So if they're giving less and less benefits, do you want to seriously put your family or even just yourself in the hands of your employer when they're doing less and less these days?
Okay. That makes so much sense.
Yeah, so you always want to have something personally, and you want to get something personal ASAP, because the younger you are, the cheaper it's going to be, and you lock in that price. And then another thing is, if you ever was to get sick with a terminal illness or cancer, you won't be able to qualify for life insurance then. So it's always better to get stuff now versus later, because one thing about it, we're always going to get older, and normally we get, our body declines over time. So it's better to get what you need to get now where it's cheaper.
Okay, that makes sense. So tell us a little bit about what's the difference between like the 401k versus the IRA.
So they're pretty much the same thing. 401k is just pretty much sponsored by your job. The IRA is an individual retirement account, pretty much funded by yourself.
Okay.
So, but you want to have both. Get going back to companies giving less and less benefits. Let's think about this. It's called the three-legged stool. 30 years ago, when our grandparents retired, they retire, comfortably because they had a 401k, pension, and Social Security. That
Mhm.
was the three-legged stool. They had three incomes coming in. Nowadays, most companies don't have a pension anymore. So that's already one leg gone from
That
the
is so
stool.
true.
And us being millennials, we might not get a Social Security if they don't fix it. So that's
Mhm.
already another leg gone. And that only leaves you with a 401k. And with that being said, many times when we get a 401k through the job, we never actually go look at it. Many
No.
many times we just leave it how it is, default set. And
Mhm.
if you're young, you want to make sure that it's aggressive so that you can take full swing.
Advantage of it.
Advantage of the volatility of the market
Mm.
versus by default sometimes it's on moderate or like the bare minimum.
The
So
bare minimum.
so you might be I had a client who been at a company for like 15-20 years, and she only had 100,000 in there because she never touched her 401k and set it to aggressive when she was in her 30s when she first got in. So she's a little bit behind the curve when it comes to that, but we made the corrections and she's actually doing way better, and it's only been 2 years.
And does your 401k kind of follow you? Okay, let's say I get one at my last job. I'm in my new job. Do I get another 401k? What happens to the other 401k that I started on my last job?
So you do start another program, but you can roll the previous 401k into it, which would be, highly recommended versus cashing it out. Because if you cash it out, yes, you get the money, but you're going to be hit with the taxes and stuff of that nature. But it's better if you're trying to, grind toward, being financially independent. You might want to roll it over because that extra bump could be the difference between retiring a couple years early versus not.
Right. Okay. So some of our listeners sent some questions that I'll just ask. So one of them is, for a typical family of 4, how much coverage should we get?
So it all depends on the family dynamic. So if the father makes about the average income in Jacksonville is about $42,000. So if they make about $40,000 a year, the dad and the mom make $40,000 a year. Typically, you want to get 8 to 12 times your annual income. So that'd be about $400,000 on both mom and dad, and then you could get anywhere between $10,000 to $15,000 on the kids. Depending on the age, I mean, it depends on how much it costs and their health and stuff like that. So, for example, me, I have $1 million coverage on me, 300,000 on my wife, and 15,000 on each of the kids, and I only pay $127 a month.
Oh, that is so cheap.
Yeah.
That's actually doable when you think about it.
Yeah, and so it just depends on, honestly, the person's age, their health, and their, what they currently got going on and how much death benefit that they're actually going to need. And the reason why you want to get 8 to 12 times is because, God forbid, something was to happen to that person. Not only is that family needs that income be replaced, and so you might get, so when we give a family a check, we like to sit down with them and plan how to, make sure that check lasts them. So we might give them access to the first half of it, but the second half we'll put into an investment. So by the time they need it, it has already grown exponentially. So we always have a plan in place, and we do that so we can make sure that family is always comfortable, always good, and always in a good financial position. Because one thing you don't want to worry about, God forbid something happens to your significant other or a family member, is stressing over bills. Because regardless if something happens to them, your mortgage still got to get paid. They keep coming. They're not going to say, "Oh, you don't have to pay this month," or "You don't have to worry about it ever again." You still got to make sure stuff get paid. So we want to make sure that although the money doesn't replace that person is still able to provide for their family even after they're gone.
Okay. And so do the premiums increase or decrease over time?
So it really depends on what kind of policy you're talking about.
Mm-hmm.
I only deal in term insurance. So
Mm-hmm.
our policies are locked in for the term, and then
Mm-hmm.
you have options of extending that term afterwards. And then depending on your options, the price could either stay the same, it could go up, or it could go down. But
Okay.
but with whole life, the policy, you're paying for two products but only getting one. So you're paying for a death benefit, you're also paying for a cash savings, that's what they call it, but you're really just borrowing money. But the premiums, depending on your policy that you negotiate, they could actually fluctuate, but you'll be paying the same premium every month, and the difference is coming out of your cash value, or eventually your policy collapses. It's just different things. That's why you always want to be able to read your policy summary.
Okay. And how are death benefits paid?
So typically the process is when somebody passes away, we you contact your agent. The agent gets a couple of pieces of information and also, the proof of death, and then we send that over to our home office, and within a couple of days the check is dispersed to that family.
Okay. So that doesn't sound like a long and drawn out process. So
No.
that's good on that part. How can I save and still get the coverage that I want?
Say that one more time.
How can I save and still get the coverage that I want?
So the best thing to do would be able to sit down with your financial coach or financial advisor, and or your life insurance agent, and pretty much see what it is that you'll actually need, and then start saving. You always want to pay yourself first. Whenever you get paid, you want to pay yourself first and then do everything else. You don't want to pay yourself on the back end, because most of the time we forget about it because we go out and splurge, or eat out, or do stuff that we don't really need, and we forget to pay ourselves first. So you always want to pay yourself first and then handle everything else.
Right. Okay. So just to kind of wrap this up, what are some crucial points you can give us about about life insurance?
All right. So make sure that that when you sit down with your agent before signing, you understand your policy, because that is very important. And if something doesn't sound right, make sure you get a second opinion or have somebody that's knowledgeable look over that policy before you actually sign off. And even if you sign off, you still have about 30 days to go back and get your money back for the initial policy. So just make sure that you go over and understand it. Unfortunately, in my office, we just had a client. She's a dentist. She makes real good money, but she was paying about $44,000 a year for life insurance. Yeah.
Wow.
44,000, and that comes down to 3,700 a month.
And, oh my goodness.
Yeah, and I honestly I can't fathom that. I mean, I've had clients in their 60s. I've had clients in their 20s, all in between, different weight classes, tobacco class, stuff like that. And never in my life have I had a client pay that much for life insurance. Never.
That is bananas. That's a whole nother mortgage and a car payment.
Man, that's some people's salaries, So
wow.
And she, she was told, not to try to get too much into it, but she was told, she got a $3 million policy, and then she also was told that her cash value will accumulate to more than $3 million. But again, at the same time, it's not really your money because you're borrowing it. When she takes the money, withdraws the money, she still has to pay it back between a 6 to 8% interest. So what we did for her was we was able to give her that same $3 million, but for $500 a month, saving her $3,200 a month. And because she was comfortable with paying that $3,700 every month, we just went ahead and invested it. And through the illustrations, if she kept her money in there at the same time that her illustration showed on the whole life policy, she'll have $5.9 million cash that she has access to. So that's hers, and she doesn't have to borrow. So would you rather borrow, or would you rather have?
I'd rather have.
Yeah. So I mean, it just is all about really understanding what it is that you're purchasing. Is about making sure that everybody is covered. So a lot of people I come across, the mom and dad might be covered, but the kids aren't, or just one parent is covered who is the breadwinner, but the other parent isn't. So you need to, if that's the case, because the price point is too expensive, you need to make sure that you're getting something that could accommodate the whole family. Because God forbid, just because you got something on the breadwinner doesn't mean the breadwinner is going to pass away first. That stay-at-home mom could be the one to go, and you'll still need income to replace them, because now that she's not a stay-at-home mom anymore, you still need somebody to watch the kids.
Right.
Stuff still needs to be done and stuff of that nature. So it's always about having a strategy and having somebody really break it down to you so you understand what it is that you're getting. Because if you don't understand it, you're going to treat it like a bill, and God forbid, when you get hard times or paycheck to paycheck hits, the first thing you're going to get rid of is your life insurance plan when it's a necessity.
So I want to thank you for joining us this afternoon. And so just our last thing is just tell us how we can get more information about everything that you talked about. Do you have a website or email? Just kind of give us some information if we need to contact you to learn a little bit more about this life insurance and financial freedom.
All right, excellent. All right, so you can text me at my number at 904-382-7218. Again, that number is 904-382-7218. And when you text, just text me your name, and then also say freedom, so I know what we need to talk about. You can also find me on Instagram, Financial Coach T. The same on Facebook, Financial Coach Terrance Brewer.
Okay. Well, thank you so much for joining us today, and we wish you all the luck, and continue to bless us and to continue to water our roots so we can all grow. I want to see every one of us succeed, and this was some great information. All right, guys, thank you for joining us today, and we'll see you next week. Bye.
Bye.